Please welcome your panel on global capital markets, moderated by the chairman of the Milken Institute, Mike Milken.
Being, isn't it? Oh my God, it's cold in here.
Good morning to everyone, and I was thinking, how can we talk about the importance of capital markets and its role in the world? So we have many of the world's greatest money managers, allocators of capital on this panel. Tom Finke from Barings, Josh Friedman from Canyon Partners, Sir Michael Hintze from CQS, and Steve Tannenbaum from Golden Tree. And so I thought maybe I would call on Jim Kim, president of the World Bank, to tell you about the importance of capital markets and its role in the future and over the past thousands of years, and what role it has played to allow us to create jobs, growth in our economy, improve the quality and length of life, etc. So let's hear from Jim Kim at the Milken Institute Global Conference earlier this year in Los Angeles.
I was with a group that we work with, faith-based organizations, and I was telling them about how important finance is, about how important it is to crowd in capital, about how the tremendous potential of creative finance to solve the problem of poverty in the world. And you know, some of the faith-based organizations just push back and say, you know, when you talk about swaps and hedges, we go to sleep. And here's what I said, because the Archbishop representing the Vatican to the UN and the World Bank was there, and I said, you know, Archbishop, with great respect, and you know, I admire the Pope so much, but I would say this. I would say that for me, my first 25 years of working in development, I didn't know anything about finance. And the last 5, I've been steeped in it, right? And I said, and I want, please tell the Pope this. I think that my ignorance of finance in the first 25 years was actually sinful. Because there's no way that we're going to be able to lift everyone out of extreme poverty unless we get much more creative about how we use the capital in the world to create good outcomes.
So we want to protect all of you from sinning today. And so we've assembled the best of the best here to talk to us about capital markets, not just in Asia, but around the world, and experiences. And the very first speech I gave on Wall Street, 1968-69, was the best investor was a social scientist. And when I think about that, it's hard to think beyond Michael Hintze and his views of the world. And I was so disappointed I didn't have 100% of our foundation's assets in his funds last year, which generated over a 30% rate of return. But Michael, I know you look at the world, you look at government leadership, you look at a number of factors. Why don't you give us your view of the world to start?
Okay, well, again, thank you so much. Look, the reality is we are in a very, very interesting time in the world, really interesting. We've got a number of very strong disruptive leaders. I mean, you can, I've got slide 12 actually, if I might start with a slide to give you a sense. There's a significant number of disruptive leaders out there. Slide 12, if it's up.
They're looking for slide 12.
They're looking for slide 12. There's a significant number of strong men out there. There are people who are making a big change in the world. And what is interesting to me, really interesting, is that these folks have got the ability to move markets. Often that doesn't happen. In the current world, they do, whether it's because of their social programs or because of their other disruptive programs. If we look at, again, slide, actually now I'm looking for my slide here. If we're looking for slide 20, you'll see that, if you go to slide 20, you'll see that there's a significant number of challenges to the Westphalian world order, something that Henry Kissinger talks a lot about. The fact is we are in a changing world. And at the moment, these geopolitics actually do make a difference to markets. And if we look at slide, again, sorry about this. If we look at slide 19, one slide before that, the biggest change we're seeing in the world is the Belt Road Initiative organized by the Chinese. This change in the world is significant. Significant. It touches 65 countries, 4.4 billion people, over half the world's population, and at the moment about almost 30% of the world's GDP. And there's no question that if I look at the major moves that we're seeing, this is a very positive move. The others are interim disruptions, but this is something which we're going to see changing the capital markets of the world, and frankly changing the whole, if you like, the whole way the world is put together. It is definitely a change in the world order.
So, Michael, just before we leave this area, how should we think about it as in providing capital as investors? How, if we can put that last slide up, how should we be thinking about this road and ability to connect so many countries?
Yeah,
Is it similar to the railroad coming to town a couple hundred years ago that's going to pass by your town in some way? What should we be thinking about?
Yeah, there's no way that it cannot have the same sort of impact that the railroads in the US had. I mean, it just can't. There are significant financial hubs which are going to be created, which are not there today. Again, I mean, we can go into the minutiae on this thing, but it makes a difference to Pakistan. It makes a difference to Myanmar. It makes a difference to a lot of the stans on the way to Europe. This is a big deal. The other thing it makes a difference to is the capital markets of the world. Aside from the fact that there'll be more activity in the regions, why does it make a difference? This will cost roughly $10 trillion. Remember, the whole capital, financial capital out there is roughly 240 trillion. This is about $10 trillion. The reality is that money is going to have to come from somewhere. The Chinese government will obviously supply some of the basis to that, but they will form a capital market structure to let that happen. In my judgment, there will be issuance of renminbi to make that happen. If we have a large renminbi market, we have an investable currency. We have an investable currency. You have a ability for the renminbi to become a reserve currency, because at the moment, the US dollar is the reserve currency of the world. Why is it the reserve currency of the world? Not just because people are trading in it, but because you can invest in it. Same thing with renminbi. If you remember, in my view, China is the driver of world growth, and there's no question it can then become a driver of world capital. We are at a very, very interesting part of our world development, in my view.
Thank you, Michael. Let me step back here for a moment and look at this formula that was somewhat of the basis of the forming of the Milken Institute a long time ago. And it was basically the prosperity. And in the world we're living in, our theme this year for the Milken Institute throughout the world is, how do we create jobs? How do we build meaningful lives for people? And this FT concept was different forms of technology, financial technology, that had to be applied to the world's largest asset, human capital. And we're sitting here today in a country, Singapore, that was built on human capital. Social capital, which has many things. One of them is the rule of law, and real assets. But the major assets in this area fall in this. And if we could pull up slide 35, for example, we could see here that there's many types of financial technology. Josh Friedman and I worked together for a number of years and worked on creating hundreds of different types of securities to how you're going to finance a company, what's the structure of that. And Steve, maybe you can take it from here and talk about opportunities in a capital structure. This group is not just focused on the debt part, but it's focused on equity, options, warrants, and other types, and how you structure portfolios by looking at different parts of a capital structure.
Thanks, Mike, and it's great to be back. I'd say the most fun part of my job is looking at relationships. Could you call back up that slide that you just had up? That was
Financial technology?
Yeah, because it really shows, if you were to just put a matrix, these, whether it's collateralized loan obligations versus loans, convertible bonds versus bonds and equity, they're all relationships to one another. And what I love doing is looking at the change in those relationships. I remember when I started out, when you were when you were talking about working with Josh, there was a big issuer was RJ Nabisco during those years, and probably the largest issuer in the marketplace at the time, and you could get the RJO bond at around 3 to 4 times EBITDA, depending upon the structure, and yielding about 15 to 20%. This was in the early 90s. Contrast that with Philip Morris, so both tobacco consumer products companies. The stock was trading around 8 times EBITDA. And so there was this, you could buy 50%, have a guaranteed return of 15 to 20%, seemed like risk-adjusted a pretty smart deal. And looking at those relationships over time. If you look on slide 25, one of these relationships between the equity market of industries in transition and the debt markets. Right now, the equity market is much more conservative and negative on industry prospects like retail. You see this on Macy's and JCPenney. This is all the junior debt of these issuers where it's barely moved, and while the equities are down 40 to 50%. You look at AMC in the theater where there's issues about when the release dates. How long will movies be in theaters now opposed to pay-per-view? Will they even be in theaters at all or just straight to video? Whiting, energy company. These are not small cap, randomly picked or small issues. It's across the industries of these issuers. These are all billion-dollar issues. If you look in telecom, looking at the Frontier, which has tens of billions of debt, relatively unchanged, the stock's down 70%. If you look at the enterprise value, if the enterprise value is 100%, most of the debt right now in these entities is 80% of the enterprise value, the vast majority. So we're seeing some real interesting opportunities. It goes cyclical. We've seen where the debt provides a much better place to buy. Right now, the equities seem to provide a better entry point. And in this environment, they just can't both be right. And so, it's an interesting relationship. And just as that slide before about collateralized loan obligations and loans, I remember on the panel talking in 2010 where the loans were trading at such a different level than what their on derivative product were, and created some terrific values.
So when you step back here, and I'm going to take you back almost 50 years, and the financial industry was really driven in these, what I call these triangles, was really driven by sales and marketing. And then came trading, and finally came research. And it struck me in entering that really the fundamental issue was research. It wasn't sales, it wasn't trading, and so our objective was to kind of flip that triangle. So today, many of the discussions between ETFs and essentially fundamental investment that are with us today, and index investment versus fundamental research, this area, Josh, I know is a significant one for you to focus on research. And with much of the markets commoditized, the opportunities often lie in complex situations that people decide they don't want to participate. Could you give us some insight into that?
Sure. One of the challenges for anybody who looks at fixed income type securities today is that valuations have been driven by this extraordinarily high flow of capital into instruments with decreasing interest rates every single year. So without trying to be someone who predicts whether interest rates are going up or going down, the asymmetry of owning a bond that has long duration and very low interest rates is getting worse and worse every single year. If you go out of investment grade, out of sovereign, you go into high yield, the problem's gotten extraordinarily acute. So you now have the highest percentage of bank debt being issued without any covenants or covenant light that you've ever had. In fact, it completely dwarfs the amount that was issued that way in 2007, and the multiple of EBITDA that bank debt constitutes is higher than it's ever been. You see the exact same thing in the bond market. So where does one look for value in a situation where you're trying to create returns that are high enough to meet a pension fund's actuarial needs, to meet an endowment's actuarial needs, or to preserve wealth and grow wealth for a family office? Our best take on this has been to find things that are complex, that no longer fit the mold that a standard ETF or a standard high yield fund can deal with, that have complexity and have distress. A good example of that recently, and one of our largest positions in the last couple of years, has been Caesars and Harrah's, which is a complex bankruptcy of one of the largest gaming enterprises in the United States. And you can see from this slide that the initial capital structure was relatively simple. You had a public company, you had TPG and Apollo owning most of the equity, and you had a holding company that guaranteed the operating company debt. And inside the operating company was a host of different casinos all over the United States, with particular focus on Las Vegas, but also a lot of regional and a few international casinos. Unfortunately, this company was saddled with a debt burden that was far too large, and then 2008 interceded, so the company wasn't really able to handle that. So in its effort to scramble around and figure out a way to rescue it, creditors woke up and found that the capital structure had been changed rather dramatically to look like this. Needless to say, a lot of people woke up scratching their head and saying, this is giving me a big headache, and by the way, the bonds are trading at enormous discounts, as low as 17 cents on the dollar for the seconds, and significant discounts on the first. What people didn't really think about here, maybe quite so successfully, is two things. One is that this was an excellent company. In an excellent industry, and one where there were no new entrants putting capital post-08, and every year consumers' balance sheets were more healed. People were spending less money maybe on their gas. They were having more value in their homes. And you get to the social trends. You talked about being a social scientist, Michael. People value experience these days, maybe experiences that are unique, maybe a little more than they value buying things. And as a result, Las Vegas has become the center of experiences, not only for older people like maybe us, but also millennials. And
I don't really think we're that old.
well,
Josh,
we're getting there. We're getting there. Nobody was inviting me to the pool party at the Cosmopolitan. But you had an enterprise whose value was growing like crazy. And if you added up the value of all the securities, you got an enormous discount to any other gaming enterprise of its sort. And there were so many levers to create value. But to play in this situation required extraordinary, it required an iron stomach, it required lawyers, it required a lot of fighting and a lot of litigation, and there was jockeying amongst the different debt categories. But complexity is where value often lies. And there's a very large universe of buyers who simply don't want anything to do with complexity. And even though the capital markets themselves are not in turmoil today, I would say they're almost the opposite. They're almost too priced to perfection in the debt markets. There are still plenty of issuers within the world that are experiencing, a record pace of disruption and aggravation in their business. Yeah. Almost half the high yield universe is either retail, which is obviously suffering quite significant disintermediation through the internet, energy, where there's been such significant change in technology that has completely turned balance sheets upside down. Media, telecom, technology. You see the biggest movie producers these days are Amazon, Netflix, Google, et cetera. Facebook is, I think, spending $1 billion in movie production, transmission of as well. And finally, you see the same thing in healthcare, which isn't on that list, but healthcare is an area that's getting disrupted by regulatory changes. And by and Michael's talked a lot in this conference about it. So if you focus on things that people are forced to sell, where people don't have an appetite for the aggravation, and you're not in the business of investing, $500 billion, there's plenty of this stuff to do, but it takes a broad platform and it takes research.
Josh, just a couple things. Give us, so the second lien area on Caesars was about $4 billion. Was that about right? The low was around 17 cents on the dollar. Yeah. After It's worked out. Where are they trading
They're
today?
trading in the 90s today. First liens were down to I think the first liens were, well, they were certainly in the 60s. They're trading at 100 and almost 130. And there's still, I believe, significant upside even from these levels because you haven't yet reached the point where you've got a simple balance sheet that can appeal to the kind of constituencies that Steve was talking about, where you just have straight debt, straight equity, and research reports from all the Wall Street firms. It's still held by a bunch of distressed players.
So this would be an interesting example. It became so complicated on one side of the coin, Josh and others that I had the honor to work with. On the other side of the coin, the Apollo TPG team that had also worked for me, who was trying to protect their side by making it complicated. But the underlying point being here, instead of buying a commodity in the marketplace today or an ETF, by putting the talent in and analyzing the credit, you discovered there was substantially more value than existed, and nothing else in the world had to change. So revenue didn't have to go up, earnings didn't have to go up, you just had to change the balance sheet. And so this was a good example, again, I would stress, of a good company with the wrong balance sheet. And to underline an issue that this whole panelist has focused on in their work, Caesars started out here as investment-grade bonds. And investment-grade bonds have little to no covenants, and that's why we wrote 40 years ago, only one way to go, down. So Tom, you obviously have the luxury here of looking at every single market at Barings, whether it's real estate, whether it's debt markets, whether it's high yield, private credit, stocks, et cetera. And so you're a worldwide investor today. How do you interact and how do you look at the opportunities today from Barings' standpoint?
Well, it is a broad world, and I think the Caesar example is a very good one of the complexity in different markets or in different corporations. There's a complexity to operating globally as well. When you go into different jurisdictions, you're dealing with different laws, just like the complexity of going through the restructuring of Caesar. At least that was within the context of U.S. bankruptcy law. But when you're making loans on the continent in Europe and you're dealing with German law versus French law, there's an added complexity. So one of the interesting things we've found as we've grown and become a global provider of not just credit, but also of equity and private equity and other forms of financing, is you have to invest in the resources locally and build the local knowledge to manage that complexity. So as we've grown last year, we have over 200 people in the Asia Pacific region, working in the equity markets, the fixed income markets, the direct lending markets. And it's that local knowledge that gives us an advantage to be able to provide credit or provide other resources in those markets. So from a broad perspective, there's a lot of opportunity in the world. It's just a matter of how you go originate it, where you find it, but what you have to do to find it. And certainly in public markets, there's an efficiency that has grown dramatically, especially with the creation of passives and very low fee indexing. But across many other markets, whether they're fixed income, credit, real estate, infrastructure debt, when we're talking about the Belt and Road, there's a level of complexity that you have to have the resources to bear against it. But if you do, there is risk premia, there is upside to what you may see in the more liquid markets.
Tom, let's pull up slide 3 and maybe comment on that a little bit.
On this slide, what we're really looking at is the risk spectrum and risk return spectrum, if you will, between traditional and fixed income on the one end, traditional private equity on the other. And in the middle, we marked two things: infrastructure, equity, and real assets backed private equity. And I think this is a good example where you hear a lot of talk about there being a lot of money chasing companies in the U.S. private equity markets, but there's also other areas to find opportunity, and I'll take the example of real assets. There's a lot of opportunity as the economy is changing to invest in assets that generate cash flow. think of things like trailers that go in the back of railroad cars and trucks. Think about things like media content. We're talking about the values there. And these are very fragmented markets where the opportunity to, on an equity basis, to acquire these assets and generate a level of cash flow out of these assets can yield attractive returns. It kind of adds an element of current cash flow. But over time, what we've done in a number of instances in the media industry, for instance, in the pharma industry, is we found working with operators, working with people who understand the assets, starting to buy the assets, and then starting to build an operating model that's more efficient than what's in the industry today, can yield enterprise value gains. So in many ways, it's looking to create the value, not just acquire it from someone else. And I think there's more of that opportunity, especially as things like infrastructure development, worldwide, but also even in a market like the US, continues move forward in a disrupting world.
Thank you. So one of the things I might comment on, we're talking about looking back 20 years, looking forward 20 years. And the dramatic change over the last 20 years in Asia, we're all aware of. But if we think back what caused this Asian crisis, it really started in Thailand, and it was really economies that were totally based on a few handful of financial institutions. And if those financial institutions got in trouble, then access to capital got in trouble. And that occurred in 1974 in the United States. And it's really an interesting lesson if you want to study history of finance and access to capital, go back and look at that period in the United States. But it really ended with denying access to capital because the financial institutions were in trouble, and that gave the growth to the public and private markets. And so in Asia, that's so dominated by a few banks, if they were in trouble, your company was in trouble. And so in looking back here, Steve, I'd like you to think about maybe comparisons today with markets in the early 1990s, and how would you look at that structure?
When I'm thinking about what you just put up, I'm thinking about some of the relationships now in Latin America and Argentina. And here you have a country changed the president, much more pro-market. They cut a deal with their creditors so that they could re-enter the markets. And there are some legacy issues, and this is on Josh's complexity theme, which I think is a great theme, that if you were just looking at Argentina debt, good value, but if you looked at different areas of Argentina with the same risk, which would be the provinces, it's much better value. And here we have the gross regional product, looking at the comparing different issuers, the provinces, La Rioja, Buenos Aires, and then the sovereign Argentina. And then to the left, you see the yield, and you just get a material pickup for what we believe is the same risk. And part of this issue is technical. When Argentina wasn't able to issue debt, they required the banks to only hold sovereign debt, not province debt. So we believe they're actually going to change that, but it's a great example of having similar, you're taking similar risk but getting very different payment. Another kind of on the complexity theme is Puerto Rico. Here you have 17 boxes, $70 billion of debt, and you have different ways to play it. The way that one box that we're very excited about is a COFINA AMBAC guaranteed box. And here you have a healthy issuer in our view. There are some challenges to its revenue, but that's guaranteed by an insurance company. Their payments are guaranteed. So Berkshire Hathaway guarantees some boxes, AMBAC guarantees this box. Now when Puerto Rico had issues, the AMBAC entity wasn't as healthy. But recently it's been recapitalized. In fact, Canyon was one of the leaders in the recapitalization. We participated. It's, that in itself is a terrific transaction. But the ability to support this box is very attractive. Jumping back to Caesars, there were different times to invest in Caesars, but I think risk adjusted, by far the best time to invest in Caesars was after the deal was set, but they hadn't come out of bankruptcy. And in Puerto Rico, I think you're going to see a lot of these types of opportunities after they're settling or I guess reaching deals on the different boxes, but there's still going to be a large risk arb premium, very similar to in the Asian crisis, what happened afterwards when it looked like there was that the different countries had gained their footing, but there were still very attractive opportunities.
I think if we can pull up slide 32 again here, I want to comment on social capital. And James Coleman was really kind of the father of social capital. And when you think about what's occurred, so Steve just spoke about Argentina. So we could say we had questionable leadership and management for 70 years. Now they have a change in management. And what Steve said is, well, one, you could invest in Argentina, or you could understand all the complexities and get substantially higher rates of return if you understood that, with similar duration and similar risk. But the rule of law, obviously this is a question and challenge for all investors around the world as governments change and what's going to happen to the rule of law and who is standing by. But when you think of Singapore and all the positives, it really focused not just on human capital, but in building this country on social capital. And the investors, I think one of the things that Michael pointed out to us is you're looking at these dramatic changes around the world. New leadership brings either new challenges or new opportunities. Michael, give us a little insight right now as to how you're looking at investing at CQS.
Well, again, there are two parts of it. Something that's common here is doing a lot of strong fundamental work to embrace the complexity and put our capital to work, mainly in the credit market. We're focused on credit at the moment. That doesn't mean there's not value in the equity. But the real interesting alpha piece, in my view, is actually trying to think about the changes we have around the world, and to think about what is the volatility that we can trade, we can aggressively be involved in. To that end, we think about the changes we see in the Middle East, whether it's what that means with oil, whether we also look at some of the challenges we see with water and climate movements around the world. We also try to think very clearly about what the transmission mechanisms are from the activities of certain strongmen, whether that makes a difference or doesn't make a difference. Again, that transmission mechanism is very much a
Michael, I want to stay on this slide you had on oil, if we could, just for a moment, because I think with this battle we're going to get into between fundamental investing and indexing. And this is an interesting chart. This is not a State Department chart of a government. This is a chart that Michael's given as he's focused on investing. Talk to us about those various countries and the structure of this chart.
Yeah, actually very exciting. And again, thank you for bringing us back to this. There are some significant changes in terms of value and cash that's being generated around the world. And what has happened since the 1970s, looking at what the price of oil is doing, Saudi Arabia, the Kingdom of Saudi Arabia, in the 70s was able to be the swing producer. Who's the swing producer today? It's the US, and that has changed where it is. And note, the marginal cost of lifting oil, and again, it's a much more complicated point than this, but this gives you the point, is in Saudi, they produce roughly 10 million of the 85, 90 million barrels a day that are needed. These guys were able to be the marginal producer, but who's the marginal producer now? it is the US, and there has been a major change. The other major change out there is Russia. And again, these guys are again putting a lot of oil into the system. But what is interesting to me is, can they be the swing producer? Can they take the pain of pulling the supply back? They might be for a while, but the reality is that Saudi has got a major fiscal challenge. They can play for a while and will not play for a while. Note they're trying to sell a good piece of Aramco on the IPO. Again, that's potentially sending other signals. Russia's got the other thing going on there. Iraq is a player in that market. And again, when Iraq was able to come onto back onto the market, again that changed matters. And not to mention Iran. Iran is again a good player there. We've got a very complicated world, and it does change who's got the money to invest and who's got the ability to move the oil price around. And the reality is that the US at the moment is the other guys who are able to bring supply on very quickly because of the Permian Basin. They can frack, they can bring it in depending where they are in the thing. 3 to 6 months the supply can come out. You want to start putting an oil well into the ultra deep water. That's a 5 to 7 year type number.
So I think, Michael, this is an example of fundamental investing. We take the attitude quite often there's very few surprises. If you've really thought about what's going to occur, there's few surprises. And understanding this, you can get a map of where all the shale is in the world, and Brazil, Argentina, etc., haven't even begun to tap their shale reserves, as Michael's referred to here in the United States. I'd like to switch now, if I could, to two trends, and go to you first, Tom. And the two trends I want to touch base on are the enormous growth in ETFs and the changes here that private equity is bringing to the world. So if we take a look at ETFs and see, and we're all fully aware of it, let's take a look at Vanguard, today's slide 60. So they were a leader in ETFs alongside of Blackstone. And this is the percentage of S&P 500 stocks that are owned by Vanguard, where it owns over 5%. So as we talk about concentration of ownership, the securitization and the ETFs of the market, we're seeing this enormous growth, and we're all well aware, particularly in the equity area, what has happened with ETFs in terms of fund flows versus mutual funds and others, and versus actively managed equities here, with a dramatic change that's occurred here, where funds have shifted into indexed ETFs, indexed mutual funds, and away from actively managed. And you can see here almost $1 trillion of movement. Let's start with the ETF effort and how you see that at Barings. Sure. And how you would structure portfolios maybe to take advantage of ETF. And then Josh, I'd like to go to you.
I think we look at it a couple ways. One, as in the equity business, on our public equity side, for years we've focused more on international emerging markets in areas where that active fundamental management still had, and still does in our view, an advantage over a pure indexing. Clearly the US equity market, extremely large liquid market. When the market is in essence doing what it's done for the last, if you will, 8 years and gone straight up, it's really hard for active managers to outperform. And I think there's something that, and we've seen this even in the debt markets over our history. At times, as Josh was saying, you can look at the high yield market and say it's very rich relative to prior years. Active managers shouldn't always be outperforming when the market is trending up in a solid line. Because part of being active management is managing risk to the downside. And I've seen in a number of our investment teams, and we run very team-driven type approaches in the different asset classes, Really an approach that when we feel markets are trending higher, we get even more selective, and we're not trying to beat a benchmark. But if you're, by default, investing in an index fund, for instance, yes, you're saving on fees, but you're also exposing yourself to unforeseen correction without the chance to really mitigate that risk. So passives are here. They should be part of a portfolio, but I wouldn't put all of your equity dollars or public equity dollars behind just indices of different markets. You still need a level of active management to manage the downside risk going forward.
Josh, let me maybe broaden the topic to liquidity in the markets with the ETFs, to the changes in the banks and regulation. If you think back 30 years ago, we probably carried inventories larger than the whole street carries today from that standpoint. So when you think about liquidity, ETFs, how do you view those markets today?
That's a good question, and I think that's sort of the soft underbelly that in a slightly longer run will produce a lot of opportunities. In the short run, we have whatever disruptions affect specific companies, specific industries. But I heard an interesting description from one of the senior directors of research at one of the big investment banks, who said in the old days you had the banks in the middle performing this great function for businesses and for investors, intermediating all these markets. And it was a bit like the castle right in the middle. Those were the banks. And then you had all the citizens who lived around. And then lightning struck in 2008, and all of a sudden the castle was in flames. And so all the individuals got buckets of water and put out the flames. And now, of course, we have a different situation, which is that the regulatory bodies globally have made such an effort to make sure that that castle never, ever, ever catches fire, that when lightning strikes, we're all going to burn up. And it's actually pretty accurate, because what's happened is with the flow into passives, and with the banks providing zero liquidity, there's really no inventory at all held by investment banks these days. An enormous percentage of the bond market never trades. So when money comes into the ETF, somebody's got an algorithm that says, well, I can't really buy that bond even though it's in the index, so I'm going to buy that bond because I can. And that works when the money's going in. It does not work very well when the money's going out. And eventually, someone actually has to take apart some of these structures and sell the bonds. We saw what happened with the Third Avenue Value Fund in the end of 2015. We saw what happened with outflows at the end of the beginning of 2016 from a lot of mutual funds. And liquidity was absolutely terrible. And the liquidity functionality that a bank used to provide was essentially provided by a number of larger funds who acted as principal.
Going there.
And so that, to me, is one of the great opportunities. And I think passive indexing and this incredible flow into passive, sure, it'll absorb a lot of supply that's brought. And I think one of the points Tom was making and Mike was making about so much capital being in private equity, it spawns a huge, 2 or 3 times that in terms of supply of debt securities. And as long as money goes in passively, I guess they can issue that stuff with no covenants, and away we go. But when it does turn the other way, it'll be a really nasty surprise for people, and it'll create a lot of opportunities.
Great opportunities for the members on this panel, right?
Yeah. If you look at, if you could call up slide 23, the equity markets, the equity ETFs have done a much better job replicating their index than what the fixed income ETFs have been. Yeah. And so if you look at the last 5 years, it's just been a poor product, a poor relative product. If you could you show slide 22?
Well, why don't you just talk through that for one moment for everyone?
So for 5 years, if you look at just the average mutual fund has outperformed the ETFs by 150 basis points. That's pretty dramatic.
Now, those are mutual funds. I'm sure, Steve, that you would be disappointed if you didn't outperform the mutual funds, wouldn't you?
Well, having run a mutual fund in the 90s, I was proud of how we did on a relative basis. Yeah. And but on slide 22, so as the composition of the market, you have the mutual funds significantly larger than the ETFs. And I think until the ETFs solve how to do a better job replicating the index, and some of the issues that Josh touched on is that product isn't available, I think the mutual funds are going to be by far the larger component here. And having been in, having watched mutual funds or been involved in mutual funds for a while, you see that their composition of the market, if you took this back, if this graph was another 10 years earlier, from 90 to 2000, you'd see the same type of ebb and flow in terms of percentage of mutual funds to the total market of, call it 10% to over 25% in the 90s. So I look at the mutual funds as having material volatility in terms of liquidity, providing opportunities. The playbook on mutual funds has been to look at which mutual funds haven't done well, look at their top illiquid positions, and then see if any are interesting. So I think that's going to be a playbook that's going to continue to be a good playbook in the next downturn.
Well, Steve, I think to echo your point, I would say today the mismatch between the assets and the liabilities of those mutual funds is about as bad as it's ever been, given the way liquidity exists in the market today. T+1 liquidity just plain doesn't exist in most of their holdings.
Michael, do you want to comment on the ETF movement at all? And
Yeah, look, I mean, the ETF movement goes back to the mismatch, which we've just spoken about, and the real challenge we've got on this point is that when money does come out of it, it'll be pretty brutal. However, let's just take it another point. Do the regulators care about this? And the reality is, we have a huge opportunity here, huge opportunity. But what is interesting to me is that when I talk to the central bankers that I do talk to, their view is, because these ETFs are not levered, even though frankly they are because of the way they're structured, but they're not notionally levered, for their view is that they shrug their hands and say, well, it's not a systemic risk. But I think it's a massive opportunity that you get from the unwind. But it's interesting, the regulators don't care.
so I want to switch to private equity if I could for a moment here. So let's take a look at slide 51. So we have a situation where more than $500 billion a year is going into private equity. And this is a slide that shows you the largest employers in the United States today. So Walmart, who's the largest employer in the world, approaching 2.5 million people, is the largest employer in the United States. Then, as you look at the employees of the companies they control, the next 7 largest employers in the United States are all private equity firms. Then you get to Kroger and United Parcel, and I'm sure we'll see Amazon in the next couple of years as one of the top 10 employers today. If we take a look at, say, slide 52 today, you can see that New York and NASDAQ today have 6,000 companies listed. If we look at private equity today, they operate 7,580 companies. So we've had a dramatic change here in who is controlling the most amount of companies. If we look at the next slide, 55, for example, and we look at the growth, in 1980 there were only 24 private equity firms in the US. Today, more than 3,000, and just in the last couple years net, they have 825 and have raised $500 billion a year. And so, as Josh, Steve had pointed out, if you leverage that 2 to 3 times on average, that's talking about the creation of $1 to $1.5 trillion in debt. And so, it was unique to us when we looked at the Wilshire 5,000 that used to have 7,562 companies in it in 1998. Even though it was called the Wilshire 5,000, today they can't find 5,000 companies. And so the public companies today has dropped almost 50%. And so when we're looking at capital markets today, obviously the same thing is being repeated in Asia, Europe, the Middle East, and around the world today. In many ways, we have an explosion of firms that are controlling numerous firms that are often the largest employers and have social responsibility as well as responsibility to investors. So let's go through quickly, if we can. How does that change here in private equity affect your investment strategies, Tom?
Well, it affects it a lot. One, because a lot of our business is around the credit markets and the global leveraged finance markets, clearly the growth in private equity benefits our ability to find opportunities to lend to those companies. And what I think is interesting is Barings is owned by a private company, Mass Mutual. It's a mutual insurance company. While not private equity, there is a difference in mindset.
What is the total assets of Mass Mutual today with your money management operations, Oppenheimer, yourself, and the insurance?
About $700 billion.
Okay.
But what was interesting is in running a company, being part of a private ownership, if you will, something that's non-public, you have a great advantage to do things and think long-term. And I think when you look at today and the disruption and how a lot of companies really have to transform themselves, being in private hands and private equity ownership, yet having access to growth capital through debt markets and bond markets, it's an advantaged place to be. I think a lot of public companies struggle sometimes with the short-term pressure, where being private, now you can take that longer-term view and actually unlock value, or more importantly, defend yourself against disruption.
Josh?
They are absolutely the front-end pipeline of everything we do. Whether because they're issuing boatloads of debt and then a minute later, if the market's cooperative, doing a leverage recap and taking their money out until it's on the edge of disaster and creating opportunities for us to help them recapitalize. And by the way, we have excellent relations even with TPG and Apollo, who are good friends of ours throughout the Caesars process. There's a process of give and take where you're dealing with a real principal who's actually an entrepreneur, and you can figure out how to maximize everybody's welfare that way. That is not so easy to do with public companies sometimes, but it's much easier to do with private equity entrepreneurs. So they create leverage. It doesn't always work. That creates opportunities. They create change. The capital structure shift. They're much, much more dynamic. So for us, that whole process of private equity taking a larger and larger share of the market is really the foundation of what we do.
Steve?
If you turn to slide 24, the only thing I'd add is CCCs as a percent of issuance are quite high now. And most of CCC issuance is private equity and M&A financings. And when you look at high issuance, tight spreads, which is what you have now, what's happened 12 months, it's been pretty poor performance. And the CCCs have way underperformed the rest of the market. So just looking at history, it seems like as a snapshot, this isn't a great time to be investing in CCCs. And I think it's terrific that private equity are they're basically suppliers to the high yield market. So it's great that we're going to get this new product, and I think you're going to get a better chance to buy it.
So I think one of the things I just comment, Steve, that a CCC at par might be a AAA at 30, right? So
Absolutely.
they don't change the rating, but there's opportunities. Josh, you were going to say?
Well, I was going to say the other part of the new issue pipeline that you get, you can wait around for the things to drop 70 points. The other thing is when the markets do get uncooperative, and they do get uncooperative periodically, is the entrepreneurs who run private equity firms tend to seek out firms like ours looking for direct loans, at which point you can negotiate covenants, you can get yourself on the same side of the table of the sponsor, and you can do some pretty extraordinary things that a commercial bank certainly can't do today. So it's really both on the private and on the public side, the secondary market and on the primary market, that they create supply.
Can I just,
Michael?
Yeah, can I just add something here? Look, clearly, huge opportunity to work with these guys, and it's actually, for us on an investing side, it makes a lot of sense. But let's think about what this really means to society in general. We are back into a concentration of ownership. The US has got the largest Gini coefficient mismatch of the OECD. I mean, that is a big deal. And one of the things that you're seeing in the numbers which Michael brought up earlier is there is a concentration in different ownership. There is a reason why the top 1% is getting richer and the bottom 1% is getting poorer. That is driving populism, not just in the US, but around the world. There is a big social movement here which frankly is pretty exciting to invest in and to work around, whether you work in currencies or in indices or wherever. I mean, we've just thrown up a slide on migration. Most of this migration, and I guess it's the same thing in the US as it is, that's hitting Italy really hard. And parenthetically, if I might just jump around here a little bit, Italy is, in my view, the next touch point Italy is the next touch point in the European project being challenged. That is a big deal. But going back here, there is a real desire for people to get wealthy, whether it's coming across the border to the US or coming across the border into Europe. And this is driving populism. It's a really interesting time to invest and time to think about the world.
So as we wrap up here, just want to make a comment on what Michael said. So when we think about immigration, the great growth in the world's population in the balance of the century is in Africa. And where those additional 1 to 2 billion people might be a desire to get to Europe for a better life. In the United States, we sometimes forget, with a relatively low population, we had 50 million people in the 1800s come from Europe to the United States over a 100-year period of time. An average of 500,000 people, no airplanes, much riskier crossings at that time. And what were they interested in? They were interested in the rule of law and freedom and all those other things, which we should only assume naturally, whether they're coming from the Middle East or whether they're coming from Africa, they're looking for also today. And I think another point we want to talk about just for a moment here that Steve touched on as we think about the private equity. When I first went to Wall Street in the late 1960s, to try to find a management team whose utility curve overlapped with investors, I discovered, much to my surprise, was a rare occurrence. Today, there's certain benefits where private equity, you have a much more aligned management because they've been hired by private equity. And the increase in the lifespan of private equity to 10, 15, 20 years, with many of the world's leading LPs in the audience here today, your desire is you don't want your money back because that forces you to figure out how to reinvest it. You'd like it to be compounding. I think we have a much longer time horizon about to be built in many of these private companies. So I'd like to now, in closing, take you into the inner workings of these 4 great firms. So Tom, when you get back next week and pull all your senior advisors in, what is the 1-minute strategy highlights that you're going to tell them as to what Barings should be focused on?
I think we're first going to continue to focus on where we've gone last year and really bringing together a platform that is diversified, not only between the markets of equity markets and debt markets, but between the public markets and the private markets. And in particular, we believe that you can look at the US and see these developments in ETFs, but it's really the future is about the emerging credit markets. It's about the emerging private equity markets in Asia and Africa and other places. And we're really trying to build a firm where we partner with our investors to directly access those markets. And that's what we've been building on for several years. And the conviction, our conviction remains the same. We think there's incredible opportunity investing behind the trends in economies where you have to bring infrastructure, where you have to build out companies to serve a growing populace and growing consumer.
Josh, what's going to happen in your internal meeting next week when you get back?
In a low yield and relatively complacent environment, don't be tempted by investments in things that are relatively interesting but low yield and complacent. Try to invest in areas of disruption, of change, of uncertainty, and try to find things where people are essentially by mandate forced to sell.
Steve?
Short beta, long event, long idiosyncratic. We all believe we're going to get better entry points because the variables of stable 2% to 2.5% growth, less than 2% inflation, low treasury yields, 10 years around 2%. We don't think those variables are going to persist over the next 12 to 24 months. And when one of them changes, the distribution or the values are going to change and create opportunities. So in the meantime, we want to be looking at event, whether it's Puerto Rico. What's the next Puerto Rico? There's 17 boxes. We want to have a view on every one of those boxes. What's the next Caesars? What's the next idiosyncratic special financing? And this is a crumbs market, and we don't want to leave any crumbs.
Michael?
Okay, well, again, one of the messages to the team is keep doing the fundamental hard yards, go deep into the companies, understand where they are, because the opportunity mightn't be here today, it might be tomorrow. But the reality is, we are in a world which is changing, and to look for the impact points, whether it's because of government or because of other corporate events, but most importantly, use your imagination. Take that knowledge and get into insight. Use your imagination, not fantasy, but do the context to make sure you use your imagination and just get stuck right in.
Well, I want to thank our panelists for their insights today, and I just want to reiterate where we started this panel, the importance of bringing capital to bear on the tens of millions of jobs that have to be created in the future and financing not only infrastructure, but the industries and companies of the future. Thank you for joining us today.
It's fun.
Really good.